Dear students, very good morning all. Today we are going to discuss second module of accounting for management, that is analysis and interpretation of financial statements. We are already discussed or heard what are the important financial statements, that is trading and profit and loss account and balance sheet. Then how can we analyze or interpret that financial statements? That is, how can we analyze the profit and loss account and interpretation of profit and loss account, and also how can we analyze and interpret the balance sheet? First of all, what do you mean by analysis? Then the data in the financial statement should be put in the simplified form to help in the analysis. After putting the data in simplified form, conclusions are arrived. Then meaning of financial analysis. First part, meaning of financial analysis. The word analysis literally means to break into parts. To break into parts. Analysis literally means to break into parts. Into parts. This is the literally meaning of analysis. Then it simply refers to simplification of data with a view to derive more information. It refers to making the data to speak. Financial analysis refers to, when analysis means to break into parts, then financial analysis refers to simplification of financial data into financial statements or in the financial statement. The financial statement discloses the numerous data. Then simplify the data by the utilization or the implementation of financial analysis. So financial analysis refers to simplification of the financial data in the financial statements. It is the process of analyzing the information contained in financial statement to judge profitability and financial soundness of a firm. Then analysis of profit and loss account, analysis of trading account, analysis of balance sheet अथवा financial position of a firm. Then it describe the profit or loss. It describe the financial positions. That means to simplify the data in the financial statement that are called financial analysis. By the utilization of ratio analysis, by the utilization of cash flow statement, by the utilization of fund flow statement, the numerous methods or tools we can use for the analysis of financial statement. Analysis means simplification of financial data in the financial statements. Financial statements are profit and loss account, balance sheet, and profit and loss appropriation account, and trading account. Okay, the term financial statement analysis, both analysis and interpretation. Then analysis means to break into parts. Then analysis simply refers to the component, that is both analysis. Financial analysis means analysis and interpretation. Analysis and interpretation. Both analysis and interpretation includes the financial statement analysis. The financial statement analysis includes both analysis and interpretation. The term interpretation literally means to explain the meaning of. That is the interpretation of 2 years profit of a specified concern or unit. Then how is the loss in the previous year or the current year or the future year? That is a comparative study of a single unit on the different period. That is the interpretation, the result. That is a meaningful of financial statements. Then explain the meaning. What is the reasons for the huge profit or huge loss? What is the explanation for the break of reputation of the firm or the goodwill of the unit, etc. In the context of financial analysis, interpretation means explaining the meaning and significance of the data, so simplified. In short, interpretation means explaining financial statement on the basis of analysis. Analysis based on the financial statement, then interpretation based on the analysis of financial statements. Analysis means break into different parts, then came into the meaningful sentence or the meaningful things. These are called interpretation. Then differences between analysis and interpretation. Then comparison of analysis and interpretation. We have already discussed the meaning of analysis and interpretation. Analysis and interpretation are two different processes. Analysis refers to the process of simplifying the complex data or the collected data, while interpretation means explaining the meaning and significance of these simplified data. So, interpretation process includes analysis or analysis are interconnected. Both are interconnected. Whenever the analysis process ends, then the interpretation starts. Let's go. Types of financial analysis. The chart explain, very simply explain what are the different types of financial analysis. Financial analysis then on the basis of material used. Second one on the basis of objective of analysis. The third one modus operandi or mode of operation. On the basis of material used, external financial analysis, internal financial analysis. On the basis of objective or purpose of analysis, short-term financial analysis, long-term financial analysis. On the basis of modus operandi or mode of operation, it can be classified into two: horizontal financial analysis and vertical financial analysis. Then, what do you mean by external financial analysis? And also, what do you mean by internal financial analysis? Both are on the basis of material used, data used, data analyzed, data interpreted, which parties within the organization or outside the organization. Then, the data analyzed, the members or the team or group and individual who are outside the company or organization. That means then this type of analysis is done by those who are outside to the business unit or the concerns, that are called external financial analysis. That is any published data will be analyzed by the numerous parties, government authority, trade unions, general public, or any other person, or any agencies, creditors, bankers, etc. They are analyzed the financial data by the publications created by any companies. So, the financial data analyzed by the outsiders of the companies, that is bankers, creditors, government agency or any trade unions, that are analyzed financial data are called external financial analysis. Then what do you mean by internal financial analysis? That means a group of person or an individual or a unit financial data analyzed within an organization. Suppose the manager of the unit analyze the profitability, analyze the profit and loss account, analyze the balance sheet of the unit within an organization for appropriate decision making or the improvement or the innovation of the business unit or the concerns. So the data analyzed within the organization are called internal financial analysis. Then external financial analysis means a person who are outsiders. Then on the basis of objective of analysis, that are short term and long term. Then what do you mean by short term financial analysis and what do you mean by long term financial analysis? Then it is made to determine the short term solvency, capacity, liquidity and earning capacity of the unit or a concerns. To know the solvency or to know the earning capacity and the any other trend of an unit in the short term period, that are called short term financial analysis. Short term financial analysis means to determine the short term capacity or solvency or any earning capacity of the business. Then the purpose of this analysis to know whether the business will have adequate funds available for its short-term purposes or short-term requirements, that are called short-term financial analysis. Next part, long-term financial analysis. What do you mean by long-term financial analysis? Then this analysis is made to determine the long-term solvency, long-term stability, long-term earning capacity of a business unit. Then to prepare the future plans or to overcome the long-term liability of a concerns in a future periods. To know or to determine the long-term solvency or the long-term capacity or the credibility of a business unit. Third one, on the basis of modus operandi. Modus operandi means mode of operation, that are called horizontal and vertical analysis. What do you mean by horizontal financial analysis? This is an important question for 1 mark or 2 marks area. That is, what do you mean by horizontal financial analysis or what do you mean by vertical financial analysis? Then, in simple meaning, when financial statement of a number of years are analyzed, then the analysis is called horizontal analysis. Number of years of data in the financial statement are analyzed, that are called horizontal financial analysis. Number of years of a single unit, that should be analyzed. 5 or 10 years profit and loss account of a single unit. Then 4 or 5 years financial position of a single unit. That is, number of years financial data analyzed are called horizontal financial analysis. Then what do you mean by vertical financial analysis? This refers to study the relationship of various items in the financial statement of one accounting period. Here 2 years or 1 to 10 years financial data should be analyzed. Here one accounting period should be considered, then to consider or to analyze 2 items. For example, current assets and current liability, fixed assets and long-term liability of a business unit, then to be compare study, that are called vertical financial analysis. Here more than 2 years or more than 1 years to be considered. Here only one accounting year. Then only single financial data is considered for the analyzation, then to consider different items or different terms or different event to be comparatively analyzed, that are called vertical analysis. Then comparative financial analysis, then trend analysis. It includes the horizontal analysis. Comparative financial analysis. Comparative financial analysis is the part of horizontal financial analysis. So 2 to 5 years or to 2 to 10 years or 1 to 10 years financial data analyzed are called horizontal comparative financial analysis. That is balance sheet or profit and loss account of a single unit. Then vertical analysis, common size and ratio analysis. Then current ratio, liquidity ratio, profitability ratio, turnover ratio. Then the different ratios to be considered of a single accounting period of a single unit. Then profitability ratio, liquidity ratio or turnover ratio, that should be analyzed only one accounting period. Here the comparative study for the 2 or 3 or 5 or 10 years should be analyzed. Then trend analysis, which is the more trend or tendencies to create a profitability, that is trend analysis. Then common size, then common nature created on which item or which event of a single financial statement. The next part, methods or tools or techniques of financial statement analysis. Methods, tools or technique for financial analysis. What are the important methods or techniques or tools used for financial analysis? Then major methods are comparative financial statements, comparative financial statements. Second one, common size financial statements, common size financial statements. Trend analysis, fourth one, ratio analysis, fifth one, cash flow statements, and sixth one, fund flow statements. These are the important techniques or tools or methods used for financial data analysis. Comparative financial statement, common size financial statement, trend analysis, ratio analysis, cash flow statement and fund flow statements. Now we are discussed first method or first tool, comparative financial statement. Then how can be applied for the financial statement analysis of comparative financial statements? Then what do you mean by comparative financial statements? Comparative statements compare the financial data for 2 or more years. Financial data of 2 or more years should be compared, that are called comparative financial statements. Comparative statements compare the financial data of 2 or more years. This is done to make financial data are more meaningful the changes, that means to increase or decrease, then previous year to comparing with current year, it may be either increase or decrease in the financial data and presented in the absolute amount or in the percentage. Then how can we implement the comparative financial statement? Then comparative financial statement applied both balance sheet and profit and loss account, income statement or financial position of a unit. Then in the case of a balance sheet, format of comparative financial statement. First column for items or particulars. First column for particulars. Second column for amount of previous years. Comparing of 2 or more years also, previous years. Then third column, amount of current year. Fourth column, increase or decrease the amount. That means to comparing with the current year and previous year value, either increase or decrease. Then fifth column, percentage of increase or decrease. This is the format of comparative financial statement. For example, fixed assets. Then financial statement, that means the balance sheet are given. Then first item, fixed assets. Then to comparative study. For example, 2012, then 2013. Amount rupees 150, here 200. Okay, 2012 and 2013. Then the comparative study of financial fixed assets. Okay, then fixed assets. Here 150. First column for fixed assets. Clear? Then second column 150. That means the previous year 2012, current year 2013. Then here 200. The next column, increase or decrease. 150, then change it into 200. Then increase. So plus 50 rupees. Then percentage of increase or decrease. Then how to calculate the percentage? Changes, increase or decrease amount divided by previous year's amount into 100. Here 50 like 2 time, then 3 time, then 100 divided by 3. That means 33.33 percentage. 33.33% increase. That means a positive value. Increase